Welcome to Towards 2015, the program to broaden your business perspective in a large market with over 600 million consumers, which is the ASEAN market.
คุณธนงค์ขันทอง our editor has a chance of interviewing Dr. Charles L. Evans, President and CEO of the Federal Reserve Bank of Chicago, on various U.S. economy aspects and also the Federal Reserve Bank policies and also the Thai economy, including the Eurozone crisis.
Weak data, economic data coming up with GDP growth and somewhat subdued inflation. But unemployment remains persistently high, unacceptable, and you appear to suggest that there is still ample room for the Fed or for monetary authorities to take action. And there is a possibility that the Fed might have to take action or make use of its balance sheets now, $2.9 trillion to purchase the mortgage-backed securities in order to inject further liquidity into the market. My question is, can we expect this to happen sometime in the third quarter of this year, and whether the size or the amount of this intervention from the Fed will be larger than the previous ones? Thank you.
I can't say that I know the answer to that. If you've been paying attention to my policy advice over the last 2 years, I've been relatively unswerving in saying that we should have more accommodation in place, more accommodation that the committee has been willing to accept. And so I found it very difficult to sort of be outside of the consensus at various times. But as I've looked at the state of our economic knowledge and our best macroeconomic models, which look at data, which capture dynamic patterns in the data, the best ones are the ones that indicate we're looking at things more like a liquidity trap, where the remedies are more accommodation. The simulation results that I have seen across a number of models indicates that we would get better outcomes. We would deliver better labor market performance if we were to adopt some of these proposals without increasing the inflation rate very far. I mean, I've seen Janet Yellen's speech was really, really instructive. It was in New York back in March. I would encourage everybody to go look at that if you have interest in this topic. She showed simulations from optimal control exercises, which basically said that best policy would keep the funds rate at 0 until 2016. Wow, that's a long time. But it delivered lower real interest rates and better economic outcomes. And then the other thing is, if by chance we get faster growth, then that means that you can raise interest rates that much more quickly. When that's the case, that's the whole thing about a conditional policy. Once you get to a point where things are doing better, then we would prefer monetary policy. But in terms of alternatives, the committee might be considering it over the next several meetings. We'll have to wait for the meetings.
So the language of the Fed might have to be altered slightly, because initially the message to the market is that the low interest rate policy will be kept until 2014. But then recently we have seen China cutting its interest rates. The European Central Bank also has lowered this rate, and the Fed has been keeping this ultra-low interest rate policy since the crisis of 2008. And looking ahead, this very low interest rate environment will be with us for the next, say, 7 years or a decade. My question is, what's the implication of this very low interest rate, ultra-low interest rate policy on the monetary policy making, not only of the developed world, but also from the emerging markets, point of view?
So I think we're in a situation where there's a fair amount of debt overhang on the part of many players in the U.S. economy and around the world. I think that the headwinds that we're facing from that, Reinhart and Rogoff talked about this very well, that extends the period of economic pain. And they sort of point out that this leads to more anemic recoveries. I just want to point out that that is an empirical finding. That's an empirical finding which should be interpreted in the following way. If policymakers continue with the types of policies that they've always pursued in response to these conditions, they probably won't be that effective, and we might have to suffer through this for the 7 or 10 years that you're talking about. But if you try things that haven't been tried before and are clear about it, our best economic analysis, as I interpret it, suggests that we can do better. So I think that it would be very worthwhile to clarify this. As soon as you say it's likely that we'll have this for 7 to 10 years, I recoil at this. This is frightening, and I think we need to try much harder to get to a better situation. I have spent more time than I'd care to mention going back and rereading aspects of the 1930s, where it's either Friedman and Schwartz or the Lords of Finance, and just sort of looking at the issues and the debt that they were grappling with over that time period. In many cases, the names are different, the challenges are the same. I think we need some type of accommodated monetary policy or accommodated fiscal policy. That would be very helpful as well.
But in Europe, the thinking or the debate is otherwise. The austerity, or whether Europe should pursue austerity programs to regain confidence, or should it pursue further economic stimulation? And would you be recommending the policymakers in Europe to pursue this single stance, of monetary easing? Or in other words, should the European Central Bank adopt the QE US style of QE monetary easing?
Yeah, I think the European situation is a very difficult one, and our own U.S. situation is a very difficult one as well. And it's challenged by the complexity of the many countries who are part of the Euro system, the Eurozone, as well as the European Union, and all of those interlinkages. And it's just very difficult for anybody to comment on that. The way that I prefer to think about Europe is to, try not to think so much about the next week, the next month, the next quarter, the next year, but to sort of ask, what is your expectation for how Europe will evolve 2 to 3 years from now, 3 years from now? And can you imagine that Europe is going to be in a strong position where they've solved this, they've addressed the weaknesses in their current structure, that they've dealt with debt issues and liquidity problems. And when you sort of get past these month-to-month liquidity challenges that the sovereign countries are having, I am in agreement with the analyses like Mark Wolf, Paul Krugman, and others that, and Harry Eichengreen, that point to the trade imbalances in Europe, and you somehow need more growth throughout the continent, and the southern periphery countries somehow need to move from running trade deficits to running trade surpluses. How is that achieved with the monetary union, where an exchange rate adjustment between those sovereign countries isn't allowed? That's the fundamental challenge. That has implications for how you might think about monetary policy, fiscal policy as well, but I think grappling with that particular issue has got to be fundamental and first order for science.
How should central banks, from the emerging markets, respond or handle the monetary policy, very easy monetary policy from the West? If you ask our government, central bank governor, Dr. Prasad, is very concerned with the international resource management, because whenever U.S. puts more liquidity into the market, that affects the dollar movement on the downward side, and this automatically creates losses to our resources. So this dilemma, how should central banks or fund managers or other investors cope with further easing and dollar devaluation?
Enormously challenging set of issues that you refer to here.
In terms of diversification too.
Yes, absolutely. I think one of the key points that everyone should recognize from a macroeconomic fundamental viewpoint is that the way we were able to navigate, traverse these difficulties over the last 15 to 20 years was like the Asian financial crisis, where there were currency depreciations and capital funding flows to the U.S. that reduced interest rates that led to refinancing booms, and the American consumer all of a sudden played a tremendously strong role in supporting emerging market and other foreign countries' trade. And that was very helpful. I just have to tell you, if you don't know this already, if you haven't thought about it enough, that American consumer doesn't exist anymore. The American consumer that is challenged by the reduction in residential house prices, that one way or another has taken on more mortgage debt, whether they did it through bad planning, moral hazard, or bad luck, and they face employment risk, the chances that they're going to expand their purchasing in order to provide a noticeable uplift to the world economy is not there anymore. And so then the question is, what keeps the world economy chugging under those circumstances? I think it requires very clever policy on the part of policymakers in every country. But business models that worked for countries in the past are going to be challenged in this case.
After a short break, we'll be back with insights on how the U.S. economy will impact import and exports in ASEAN, as well as Barack Obama and Mitt Romney's policy campaigns, how they'll be tackling the U.S. economic crisis, and many more after the short break.